Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have John Cole-Scott, Chief Investment Officer at Closed-End Fund Advisors, known as CEF Advisors, to discuss the key features of a listed closed-end fund and what makes them compelling investments. John, it's great to see you again. Welcome back to Trade Talks.
Great to be here again.
You got it. So let's start with the basics. What are the key features of a listed CEF and what makes them such a compelling investment?
Well, I mean, they're not new. They're around since 1893, trading in the United States. And what they really are known for is that they have a net asset value like the other regularly known funds, but they trade on exchanges at market prices. So you get elastic and unconnected discounts and premiums in the pricing of the funds, and can be a very good way to react to a contrarian view in the market. When people are excited, they tend to bid things up. When they tend to be scared, they bid things down, and you can tap into that with the market. They're also known for having good use of level 2 and level 3 assets because they don't have that redemption on a daily basis like ETFs and open-end funds. And so you can have less liquid investments, and active managers can do more granular and interesting things in the portfolio, really maximizing that closed-endedness of the fund. And also they have the ability to do both portfolio leverage and like structural leverage, like a preferred stock or other mechanisms to allow enhanced income opportunities. And that's a benefit in most markets to most investors. And then we really just find that even though they're so old and we've been specialized for over 30 years, my father did it for 50 years, that they're just never fully understood. And I love the inefficiency of the market to give people a chance to do their homework and have some fun.
Yep. All right. Well, we're at the end of the year, right? So what do CEF investors do at this time of year? And is there price seasonality as it relates to CEFs?
It is. So, I mean, there's the January effect and tax loss selling season across other securities. Because of that discount mechanism, discounts traditionally widen and narrow over 3% for the whole universe of over 400 funds. So imagine a year like this where stocks and bonds are down, we're expecting even wider discount selling pressure for the universe of funds. And then typically in January, you have a nice rebound, or the elasticity of the funds bounce back up for potential alpha over whatever the net asset value does. So yes, we always like to make money from the NAV going higher, but this is a way of potentially making extra money or just having a more access to the market this time of year. Very good by year end, and usually pops by mid-February.
While the IPO market is cooled with the challenging returns this year, what have been the trends the past few years in the CEF and BDC IPO market?
Yeah, so we had the last regular IPO in February this year, kind of in line with the market sentiment. We have a lot of newer funds that have generally 12-year terms, where at the end of those terms are come back in net asset value, but only one small muni fund this year with a target term trust. So what that means is when there's not as many funds in the primary market or the IPO market for closed-end funds, it usually gives a nice discount, tailwind, or support to the secondary market, the fund's already trading. And so while the market is always unknown, these discounts are relatively wide. And those CEF 2.0 funds with that term trust at the end, they're trading on average 5% wider. And the best analysis we've done is a blend of two factors. One is they were larger funds, and some of the advisors that purchased them for clients weren't as familiar with closed-end funds and maybe thought discounts would never happen. And then, of course, we've had a very rough market for almost everything. And so there's been downward sentiment on newer things in our experience.
Where do you see the best opportunities in 2023?
So we do the work for our clients. You know, we really like to pair things. So with interest rates just popping up another notch, probably some more to go, but I don't have a crystal ball. I would say preferred funds and muni funds, the duration risk is far lower than 6 months ago. And we're finding a great after-tax place for clients. And then we also love things like business development companies or BDCs and loan-focused funds, because those are a different type of credit than the others. They're not tax sensitive, but they allow the ability to track growing dividends with rising rates. So for example, muni funds in the last year have reduced dividends about 20% on average, and BDCs have raised dividends about 15% on average. No math is perfect, but that's nice to have in a portfolio when you're expecting or hoping for regular income through the life of your account.
All right, John, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.